Every year, the world's governments lose $427 billion to offshore tax havens. That figure comes from the Tax Justice Network's 2020 State of Tax Justice report, and it is enough to fund the entire NHS 5 times over. One tiny island sits at the heart of this system, and almost no one can stop it. The Cayman Islands is a British overseas territory in the Western Caribbean with a population of fewer than 65,000 people as of the 2021 census, smaller than many suburbs. Yet as of 2019, it ranked as the world's 5th largest banking center, according to the Cayman Islands Monetary Authority. More money moves through this archipelago than through most major nations. As of 2020, over 100,000 companies were registered in the Cayman Islands, nearly twice the number of residents. Many occupy single shared office addresses, home to dozens or even hundreds of corporations simultaneously. These entities produce no goods, employ almost no local workers, and conduct no meaningful trade with the Cayman Islands itself. The mechanism is elegant and entirely legal. A multinational corporation books its profits in a Cayman subsidiary, which charges the parent company in a high-tax country for the use of intellectual property, patents, trademarks, software. The high-tax entity pays a royalty, reducing its taxable profit at home. The Cayman entity collects the royalty and owes zero corporate tax. In 2016, the European Commission concluded that Apple had paid an effective corporate tax rate of just 0.005% in Ireland in 2014, routing profits through Irish subsidiaries with special arrangements. The Commission ordered Ireland to recover €13 billion in back taxes from Apple. Apple won its initial appeal in 2020, though the EU's own Court of Justice reversed that ruling in 2024. The Tax Justice Network's 2020 report found that lower-income countries lose a disproportionate share of their tax revenue to these arrangements relative to their GDP. When corporations avoid taxes in developed nations, those governments compensate by cutting public services or raising taxes on individuals and small businesses who cannot use offshore structures. The burden shifts downward. In October 2021, 136 countries signed on to an OECD-led agreement to establish a global minimum corporate tax rate of 15%, targeting the largest multinationals. It was described as the most significant reform of the international tax system in a century. Implementation timelines varied by country, with the EU member states adopting the rules for financial years beginning in 2024. Despite the 2021 OECD agreement, the Cayman Islands remains a zero corporate tax jurisdiction as of 2024, and the global minimum tax applies only to companies with annual revenues above €750 million, leaving the vast majority of offshore structures untouched. The system that extracts hundreds of billions each year was not built overnight. Ending it will take far longer, if it ends at all.